What's good, bitches? Welcome to this Trading Basics webinar. I am your muse, Monica, and welcome. Welcome to my channel. Welcome to my trading journal, Impressive Investments. This channel, if you've clicked on this video, you are likely interested in learning trading. And that is exactly what this webinar is designed to help you learn the basics and decide if futures trading is right or best for you. All right, so if you're ready to your cherry, let's get started. All right, so first we're gonna get into what trading actually is. All right, so let's dive into what trading and futures trading are all about. Right, so trading is essentially about buying and selling assets with the objective to gain from the market's movements. Now, when we talk about futures trading, it's a little bit different. A futures contract is an agreement to buy or sell something at a specific price in the future. All right. Now, in our context, you'll come across terms like MES and MNQ, and respectively meaning a micro S&P and the micro Nasdaq. All right, so it's very important to note that you are not buying the overall or individual stock like you would an Apple or a Tesla stock. Instead, you're trading the overall direction of the larger stock indexes, the price movement. All right. So remember, the focus here is on the movements and the direction of the market, not the individual stock of shares. All right. This conceptual shift is very crucial in understanding how futures trading actually works. Crucial in understanding if you actually want to be successful in futures trading. Right. So let's talk about maybe why you would want to trade futures, okay? So you may have come across things like Forex, crypto, options, futures, right? So trying to decide which basically is the right for you, for your lifestyle, it's all up to you, right? So basically, a little bit about me. I started trading in 2022. I started with options contracts, calls and puts, and I had minimal to zero understanding about the market or what I was even doing. The goal was really just first to invest money long term, but also kind of trade and make plays to grow my account as well. Now, options, calls, and puts wasn't in itself difficult to grasp because I was working with a very small, low account size, but it made making any money relatively impossible because price targets would be so far out of the money. All right, in order for you to make anything, you would have to get your price to a specific target, right? So let's dive into why futures trading was more attractive to me and could be more appealing option for many. All right, now based on if y'all followed me for a while, y'all know that I've kind of in this futuristic spiritual side of life. So futures even more I was drawn to. I like to tap into the future. All right, so why are futures besides that personal reason? It's small account friendly, right? Like I was saying, with options, it was small account. You were working with a low account size, so you can start with only a little bit of money in order to control a larger asset, right? So you have micro contracts, which make it accessible without needing a huge initial investment. All right. So also, futures offers a high liquidity, which means there will always be a buyer or a seller ready, making it easier to enter and always exit trades. Additionally, you will have clear market sessions, allowing for more predictable trading options. You also have something as they call leverage. Leverage is a very key advantage when trading. All right, now with futures, you can control a large market value with a relatively small margin. This can amplify your gains, but also your losses. So it's very important to understand the risks involved. All right. Now, finally, there is the no PDT rule, pattern day trading rule. Another thing with options, calls, and puts is you can only take 3 trades a day and you'll be flagged for pattern day trading, whether you're buying or selling. And that was kind of what I was running into. Trading back then, and back then I was really like new. I was new mom, learning homeschooling. Like it was like our first years in homeschooling, really single. We had just kind of separated. I had just really been separated from out of like a 10+ year relationship. So learning that wasn't trading and life psychology will go hand in hand. Whatever you have going on in life will automatically reflect in your trading, right? So now here in a space where we're more mature, we've gone through many phases, cycles in motherhood, in life, in relationships, and even in trading here, we can focus a little bit more on it, right? So basically, pattern day trading, which basically means there's no rules, so you can trade as much as you want regardless of your account size. So another thing about futures is you can take as many trades a day, risk managing with risk management regardless of your account size. All right. Now, these benefits can make futures trading a very attractive choice for traders, and for traders, especially those who are just beginning and starting out. All right, so let's get a little bit into impressive estates. All right, let's tap into the impressive kingdom. All right, so we're gonna set a little bit of scene. I'm gonna tell y'all a little bit of a story. Okay, so welcome to Oppressive Estates. All right, so imagine you are stepping into this magnificent realm where there are two royal horses, MES and MNQ, awaiting you. These horses symbolize very powerful and the expensive micro S&P and micro Nasdaq. Now, they are truly worth tens of thousands of dollars. Have y'all don't know what Belgian horses look like? Belgian horses are some of the most powerful, strongest horses. Okay, look them up. Imagine these are our two royal horses, okay? Together, they're truly worth tens of thousands of dollars. However, much like in our kingdom, you won't be buying the entire horse. Instead, the kingdom will allow you to the chance to guide these majestic creatures, a chance to guide them with just a small ribbon deposit. This ribbon is also known as our margin. All right. Now, margins are going to be very important and essential in futures trading because, like in options, it's not necessarily mandatory for you to have a margin, while in futures trading, you need one. All right, and we'll get into that a little bit next. So when you see a $40, when you see $40 entry cost, remember that this is the price. This isn't the price of the horse itself. It's akin to a princess ribbon that grants you privilege to the ride. This concept is known as leverage, which allows you to control something immensely valuable with a relatively small deposit. All right, so you can think of leverage as your magical key, this magical key that helps you enter into the kingdom, empowering you to guide these beautiful, powerful market horses without even needing to own them. Okay, so it's going to be a very powerful tool in the trading world, making futures more accessible to many people. So, like I said, margins are going to be very essential in futures trading. So, let's talk a little bit about what margins are. So, have you ever wondered how you can control something as substantial as $25,000 with just a small deposit? That's where the concept of margins come into play, all right? So, simply put, margin is like your security deposit. You make the security deposit to control the contract, not the cost of the contract itself. So, for instance, if the micro S&P or MES is valued at 5,000, the contract value becomes 25,000. Yet, you only need to deposit around $40 to $100 for day trading, or at least for this to be in your margin account. All right, this means that you're leveraging a large sum with a very small margin, a very empowering tool for traders. Remember, margin allows you to guide the market without the full cost of the contract. So nobody has $25,000 to play one contract. So your margin is basically your deposit to ensure that you can play this large number with just a very small deposit. All right. So next, we'll take a delightful little journey into the realm of impressive estates, where we'll continue this story here. Okay, talking about the margins. So let's talk about initial margins, aka our entry tickets. So think of this as the security deposit, all right? This is going to grant you access to the trading world. It is very important to clarify the difference between the initial margin and the maintenance margin, okay? Because initial margin does not represent the full value of the contract. Rather, it is the minimum cash reserve necessary to unlock its potential. So, for example, you might require approximately 1,200 to 1,600 for micro S&P, or 1,600 to 2,000 for the micro E-mini Nasdaq at the exchange level, right? But during market hours, however, many day trading brokers often reduce this requirement to a much more manageable $40 to $100. So it is essential to recognize that this is a broker specific adjustment, not a standard practice established by the exchange. All right. So depending on your broker, you may only need $40 to $100 in your margin. Right now, by perceiving the initial margin as your entry ticket, all right, as your ticket into the kingdom, you are going to be better prepared to enter the trading universe with a much more strategic mindset. All right. Now, we are talking about the maintenance margin. What is the maintenance margin, and how does that differ from the initial margin? All right, so let's talk about it. We can call this as the stay in the castle money. All right, so you have your entry ticket, and now you're in. Now you need your stay in the castle money. All right, you solidified your spot. This is going to be the minimum balance that you must maintain in your account in order to keep this position, meaning that your account cannot fall below a certain amount in order for a position to remain open. So Imagine you're staying at our luxurious castle on impressive estates. You can remain in your room, but only if you can continue to afford it. If your account falls below this level, you might receive a margin call or your broker could close your position. Okay, so it is very important to know that the maintenance margin is usually a bit lower than the initial margin at the exchange level. All right, so I'm sure you want to know how your horses are going to pay you. How are you getting paid through all of this? So let's explore how this looks when it comes to trading with our MES and MNQ. All right, so starting with MES, which pays you $5 per point. So if you make a 10-point gain, that's a $50 increase. And a 20-point gain would bring you to $100, increase. It's very straightforward, but it is important to remember that every point counts significantly. Okay, so now if you're moving on MNQ, it's going to be a little bit different. It's only going to offer us $2 per point. So if you accumulate 50 points, that is going to equate to $100. All right, it's pretty, like I said, pretty straightforward. You can see how the dynamics between these two differ between the MNQ and MES, both in terms of the payout and the strategy. All right, so depending on which ones that you like to play, I do kind of tether between the two of them. um, I've kind of been more drawn to S&P a little bit more than NASDAQ, but it's all up to you because even I'm sure down the road we'll incorporate gold as well. So it's going to be what is very crucial here, especially in this trading and future trading, is going to be the mind shift, the shift in mindset, the shift in the way that you think. As the princess on our estate wisely notes that it's not how much, you're not going to worry about how much the contract is, right? But rather, how much do I win or lose per move? All right. This approach will help us to focus on the tangible outcomes of each move, which is essential for effective decision making. All right. So, with this understanding, will set the foundation as we move into risk management strategies. All right. Now, risk management. I'm sure you've heard this term if you've even begun a little bit learning about trading. Um, Risk management is going to save your life and save your wallet, save your pocket, save your account. All right, save everything that you've worked hard for. If you hear a lot of these stories, it's because of poor risk management. It's because of, first, poor psychology, and then two, because of poor risk management. All right. So, what is risk management? AKA our stop spell. Ooh la la. Okay, we put a spell on you. Now, let's talk about our stop spell, okay, because this is crucial, very crucial part of risk management. Imagine that before you embark on your journey, you, as the princess, sets a clear boundary. She decides, if I lose this amount, I will step off. I will step away. I will step back. All right? Take a pause. Remember that life psychology always equals trading psychology, and you can reverse it here. If you lose a certain amount at a job, in a relationship, dating, you step off, you step away. All right, this is how we manage risk. in life, in love, in our money. All right. If you lose this amount, you step away. Right? You're setting a clear boundary. You're deciding when and how much you're willing to tolerate, how much you're willing to risk to lose. All right. So this is our safety net, our contingency plan. The risk formula is simple. Stop size multiplied by the dollar per point multiplied by number of contracts. So let's break it down with an example, right? So if we have a 10-point stop on MES, that is 10 points times $5, giving us $50 risk. All right. The key principle in trading is to only risk 1 to 2% per trade. This disciplined approach will ensure that your account can withstand the ups and downs of the market. And it's just overall, it's about survival and longevity of your account, right? So by using this strategy, this stop spell, we're going to be protecting our castle, our state, ensuring that we're in the castle for the long haul. All right. So a little bit more about risk to reward management, and what this is, what the R&R is. So you will often see our risk to reward abbreviated as just this, as our R&R, right? So the principle here is very straightforward as well. We are not going to, or we don't want to risk $50 just to make $50, okay? Instead, our goal is to aim for a possible ratio of 1 to 2. All right, if we were going to risk $50 just to make $50, that would be a 1-to-1. We want to at least make it a 2 or a 3. Ideally a 1 to 3, right? So let me give you an example. If we risk $20, we are going to aim to make $60. This approach means we are taking a small risk for a bigger reward, which is crucial if we want to consistently grow our account over time. Now, remember, the key takeaway is that by maintaining this kind of ratio, we're not just protecting our accounts, we're setting ourselves up for substantial success, okay? So let's move forward, and with this mindset, ensuring that every trade is going to align with these principles as you go forward. Make sure that your R&R is a 1 to 2 or a 1 to 3. And never go outside of your trading rules. Don't break your own trading rules. Set up your own rules. You always want to set up your own rules, which works best for you, what time, what market, which trends. Are you uptrend, downtrend? There's a lot of things that you need to think about psychologically before you jump in to trading here, okay? So I want to shift very slightly onto futures markets trading hours here, okay? Because remember that all the times displayed in the futures market are going to be displayed in U.S. Central Time, specifically Chicago. This standardization ensures that we're all on the same page regardless of where we might be in the world, right? So trading hours are very greatly can impact market behavior. So understanding them is going to be very crucial. This awareness will help in planning our trades and managing our strategies effective. I personally like to trade between 8:30 pre-market and 11:30. That is usually when there's the most volatility. I might come back after lunch hours, and look at trades around 1 to 2. But the market is a little bit slower around those times. All right. So keep in mind that market dynamics can change at different times during the trading day. So being aware of these hours gives us the opportunity to align our trading strategies with times with the most where the market is most active. All right, so now let's move on and explore about market behavior, learning to interpret the stories told by candles. Candles, candles. What are candles? What is a candle? A candle captures the behavior of the markets over a specific period of time. It tells us where price started, how far it ventured, and then where it ended. It's just a story. It's a storyteller. All right. It shares the narrative of an agreement or disagreement among the market participants during the time. So it's just telling you what happened in the last hour, day, 5 minutes, 1 minute, depending on what time frame you're looking at. That candle is telling you a story about that very specific time. All right. So it's going to be important for us to remember that a candle doesn't predict the future. It's not telling us whether something price is going to go up or whether it's going to go down. It's simply telling us what happened in the present moment. Okay. Um, it simply reflects past actions and outcomes. When you read candles, you're searching for signals or clues. All right, so don't be looking for a bunch of signals. Don't be looking for a bunch of clues as to price direction because it usually doesn't. Um, it doesn't always 100% tell you how price is moving. Instead, we want to look at and observe the behavior of the participants and where they ultimately settled. All right. So the point of reading a candle is not to tell us price direction, but ultimately to tell us where the price settled. So this understanding is also crucial because it allows you to see beyond the surface and delve into the dynamics of market behavior. All right, so let's talk about the colors, right? Because a lot of us naturally will associate red and green with things like good and bad, negative, evil, all right? But color, candle color means nothing, all right? Our candle colors, as you see, we'll get into our charts that our candle colors are completely different. All right, so firstly, remember that red candles do not equal good and green colors do not equal bad. The color of a candle is simply going to give you information, not a directive. All right, so a green candle will simply indicate that the price closed higher than it opened, while a red candle might indicate that it closed lower. It's crucial to remember that these colors aren't signals. Again, instead, they're part of a larger story about market behavior. This brings us to an important takeaway. Experienced traders don't react to color, they focus on context like location, structure, and behavior. The market is all about agreement, not color. It's easy to fall into the trap of associating green with safety and red with danger, but truly understand market dynamics. Focus on the bigger picture. All right. So that's why we at Impressive Investments have transitioned our aesthetic to cherry blossom hues. All right, a decision made to enhance our environment. All right, the traditional association of red and green is often evokes anxiety within me personally, as they often signify stop or go or good or bad. just brain, the colors automatically signal that in your brain, right? So by altering our candle colors, we not only cultivate a more serene trading atmosphere, but also foster a more psychological sense of structure, allowing for a more focused and organized trading. All right. Now, let's move on to understanding the support and resistance, which will also help you to stop chasing and start waiting. All right. Again, this concept goes into life psychology. All right. It's the concept of support, resistance, waiting versus chasing, being patient, boundaries. Trading will highlight a lot of your psychology. Okay. So, what are support and resistance? Support and resistance are very key concepts, okay? And you're probably going to hear them or you have heard them within trading, all right? These are going to be two concepts that is very important for you to grasp as they help you understand where price might be heading next, all right? So, support is like our floor, it's the area where buyers have historically stepped in to prevent price from falling too low. Now, on the other hand, resistance acts as your ceiling, where sellers have previously intervened to stop prices from rising too high. All right. Now, remember, these aren't just lines on a chart, all right? We're not just marking and making lines on a chart. These are zones. And within these zones are very specific boundaries. These are prices tend to move more steadily, more consistently. All right, but when prices approach these boundaries, decision making often intensifies as it often leads to increased volatility in the market. All right. So, understanding these concepts will allow you to stop reacting impulsively and start making more informed decisions. All right. So, instead of just jumping in, you can't wait. You can't make them wait. This is learn to make them wait. Learn to make yourself wait. Patience here, right? So instead of just dumping in, you begin to wait patiently for the right opportunities to present themselves, and for the right opportunities to come to you. We don't have to be too eager. We don't have to do and take the first thing that we see. That's how we lose, and that's how we lose real quick. All right, so let's move on. Basic order types, okay? Let's talk about the basic types of orders that you can place in the market. Excuse me, I feel a sneeze coming on. Okay, so let's dive into the fundamental order types that every trader should be familiar with. So, understanding these will lay a foundation for your trading journey. First, we have the market order. This is going to be your go-to when you need to instantly enter into the market the current market price. Excuse me. It's straightforward, it's very fast, and it's perfect for those moments when timing is very crucial, when it's very volatile. Next, you have a limit order. This is here when you want to set a target price, allowing you to enter or exit a trade at a price of your choosing. All right, so it's all about control and precision here. Now, next we have the stop loss. A stop loss is very essential. You always want to place a stop loss no matter what. At least I think so, okay? This is an automatic safety net, all right? This is an automatic exit exit door, exit sign. This is going to be designed to help you protect your capital when the market moves against you. It's very essential for our risk management that we talked about, and helps gives you an additional sense of peace of mind. All right. And then finally, we have our take profit tool, which is used for you to secure your gains, right? So the market is moving really fast. You set a TP, a take profit, and those will automatically closes your position once a set profit level is reached, ensuring that you lock in your very hard earned profits. Okay. Now, mastering these basic order types is going to be important. They are the building blocks for more advanced strategies and help you maintain discipline within your trading. All right. So remember, the key to success is not just knowing these order types, but when to use them and when to use them wisely. Okay, so I believe we're almost at the end here, you guys. So, a little beginner friendly strategy framework for you all, to put this in a little bit of an impressive structure for you. Let's talk about your framework, your mindset with going into these futures trading. Because designing or building a solid foundation for your trading journey is going to allow you to be so much more successful, not allow you to be overwhelmed with it additionally. Okay, so first, remember that trading one contract when you're starting out as a beginner, one contract will help you to keep things manageable. It helps you to stay focused. It's crucial to risk only 1 to 2% of your capital per trade. This keeps your potential losses to a minimal and helps to protect your account and your peace of mind. Next, we want to ensure a defined stop loss. We want to ensure that stop loss, your safety net, all right, automatically set a boundary for exiting trades that don't go your way. It's essential to wait for trend confirmation before entering a trade. This patience can be the difference between success and unnecessary losses. All right. Now, lastly, please avoid the pitfalls of revenge trading. All right. I'm sure there are lots of stories out there about revenge trading. Even if you found yourself hopping in, in your beginning journey and wanting to recover some money that you just lost. Look, look, look. Trading should be about structure, not emotions. It's never emotional over here. In the oppressive estates, unfortunately, when it comes to trading, emotions have to go out the window. Emotionless. Honestly, when you go into trading in the mornings, you have to be in such a neutral energy. Otherwise, your day, I promise you, your day will reflect your trade. Your trade will reflect your day. Okay? Because we trade with a plan. We don't trade with impulse. We don't have to impulsively do anything. We're too pretty. All right? We let things come to us, right? All right, so remember that this framework is going to be crucial, or it's going to be essential in helping you cultivate your discipline and your consistency. So let these key principles be at the top of your mind as we continue. All right, trading psychology. Let's talk a little bit about trading psychology. We have another webinar on trading psychology. So if you're interested in that, you can check out the link in the description or in my bio. All right, let's talk about something that often gets very overlooked, but is so important when it comes to trading. And again, that is trading psychology. Why is it so important though? It's important because the discipline of trading will always outweigh the strategies in trading. You can have all of the strategies in the world, but if your mindset and your discipline aren't top tier, you're honestly nothing as a trader. Okay? Because most accounts fail due to a lack of discipline, not a lack of strategy. They fail because of behaviors like overtrading, oversizing, and moving stops. All right, so you go against your rules. These are common pitfalls that traders fall into because they're fueled by emotions. All right. The emotional revenge trades are particularly dangerous. It's when you try to recover losses by making rash decisions, often leading to even bigger losses. Who wants to be an even bigger loser? I don't. Alright, that's not in good for the impressive brand. Alright, you sitting in your castle looking like a loser. It's not cute. Alright, remember, futures trading will always amplify your behaviors in real life. If you're chaotic in real life, the market will expose that, it will reveal it. So, maintaining discipline is not only beneficial, it's essential. Okay? So think of trading as your mirror, your divine mirror. If you don't have an accountability partner, baby, let me tell you, this is one. All right. Ain't nothing going to check you and humble you quick than losing all that hard earned money you worked for and having $0 in your pocket. All right. It's going to reflect your discipline and lack thereof. All right back to you. So, be careful, work on the psychology of trading before you even take a trade. Understanding the psychology before you even take a trade. Hearing too many stories of people, they're hopping into their first trade thinking they know what they're doing, and it's basically out of emotion. Alright, so I believe we're almost at the end here, guys. There are a couple things that you need to start trading. All right, to even begin trading, you need 3 essential tools: a charting platform, a broker, and a funded account, of course. But that is optional because, as you see, we do a lot of demo trading in our beginner journey. First, let's talk about the charting platform. So this is where you'll analyze market trends and develop your strategies, choosing the one that fits with your needs best. Next, you'll need a broker. This acts as the intermediary, executing your trades. It is essential to research and select one that aligns with your trading goals. Not all brokers are the same. All right, they're not all the same. Their intraday rules and how much margin and things like that vary across platforms. Now, lastly, while a trading account is optional, it can provide you with a lot more real world experience over the demo trading, because demo trading is basically monopoly money, and you aren't as emotionally invested in it as your own hard earned money here, right? But starting with a demo account will always be more beneficial to practice without financial risk. If you want to just learn and chart and play with tools, losses and gains, I promise you can never go wrong with a demo account. I would recommend 3 to 6 months demo trading before you even take a real trade with your own money. But that's just me. But that's just me, okay? That's just the impressive one. Now, some brokers for futures traders, you have ones like Tradeovate, NinjaTrader, and AMP Futures. Okay, you can connect these directly to TradingView or directly to your broker platform. Okay, these brokers can be connected directly, whichever best suits your style. So let's talk about day trading margins, because typically the margin ranges, like we talked about early, from 140 to $150 per micro contract. But remember, and this is crucial, a margin isn't the same as a safe account size. For beginners, it is recommended with an account size of at least $500 to $1,000. All right, so if you're just starting out as a beginner, $500 to $1,000 is your safety net, is your minimum. All right, to get into this futures trading. This gives you a bit of a cushion and room to learn without the pressure of being undercapitalized. All right. Now, some of you may be intimidated with the $500 to $1,000 minimum. All right. And honestly, I don't think that's unattainable. For the future that you're trying to cultivate, if you're into trading and very serious about it psychologically, a $500 to $1,000 minimum, and even obtaining that shouldn't be too daunting for you. You have tax refunds, you have passive income, side income, side hustles, savings. I'm not gonna pretend like it's totally easy to just come up with $500 to $1,000, but that's also why we practice stocks. All right, that's also why we practice our investments, why we DCA. We can talk a little about DCA real quick, dollar cost averaging into a trade. I used to do that into a lot of my stocks. DCA, put $5, $10, $15 in a stock over time. And you can do that with an account, with your account and your savings over time. DCA, every time you get paid, DCA into your savings. And then when the time comes, as you're learning, as you're demo trading, now you've spent the last 3 6 months demo trading, while you've accumulated your $500 to $1,000 to put into your account, and you're ready to go. But we also got another option for you here, okay? Because using your own money doesn't always have to be your only option. All right. The good thing about futures trading. Okay, apologies, guys. I don't know what happened. Well, my camera glitched out. I needed to clear some storage. So we're going to continue with our webinar, okay? So we left off on paper trading or demo trading. So before we dive, or you dive into live trading, or you want to get into live trading or using your own money, funding your own account with your $500 to $1,000, demo trading, or also known as paper trading, is the best thing to start with. It's going to be the best thing as a beginner to start with. You never want to just hop straight into your account using your own money as a rookie, because you don't know what you're doing, and I promise you you're going to lose money. Okay, so on TradingView, you can open a paper trading account where you can set your own balance. For example, $10,000, $5,000, $10,000, $50,000, $100,000. This is your sandbox to play with, okay? Here, you'll trade just one contract at a time, the focus being on practicing stop placement and tracking your risk to reward ratios, often referred to as your R&R. Okay, and remember, the goal here is consistency. We want to build consistency over 30 to 60 days. They say that it takes about 60 to 90 days to form a habit, so we want to be consistently getting up, disciplining ourselves, getting into the mindset, the groove, the frequency of trading, of being consistent, because this consistency is your indicator that you are going to be actually ready to consider live trading, to consider using your own money. And an important rule to remember: no real money trading until you're consistently profitable in your demo account. No real money until you are consistently profitable in your demo account. That's just me. That's just our rules at the Impressive Estate. Okay. because by using this approach, trading this way, you'll build a lot more discipline and skilled without all of that strategy and fluff and without the financial risk. We want to keep our profits pretty. All right, we want to keep them impressive. All right, so like I said, we were talking a little bit about prop firms. There is another option to use something other than your own money. Now, once you a big reason why demo trading is going to be very important, crucial, essential for your step is because we ultimately want to get to the point where we can use a prop firm. We can use other people's money. As a Scorpio, 8th house, other people's money is always an asset. We want to keep our pockets fat. All right. Now, trading prop firms offer a unique opportunity for traders with the firm's capital after successfully passing an evaluation. Okay, so we're going to talk about how this process works and kind of what it takes to succeed. So, if you are interested in a prop firm, I think it is best to train to trade for a prop firm exam. Okay, so you'll want to basically go over the different prop firms, what their evaluation process is, what your account size is. So often you'll want to they'll have denominations like 50 to 100K. All right. The key here is to adhere strictly to the rules set by the firm. These rules will typically include a daily drawdown limit, a maximum drawdown, and a profit target you can reach to pass the evaluation. Now, here's where the discipline will come into play. You must risk small and avoid overtrading. It's crucial to hit the price profit target without violating any of the rules. This means prop firm trading is all about the discipline, not the speed. You want to remember that the goal is to earn the firm's trust, which leads to being funded and receiving those payouts. So, prop firm trading is going to be a very disciplined approach that receives rewards carefully and calculated. With this calculated trading rather than fast paced, impulsive decisions. Keep this in mind as we move forward. All right, I want to go over our rules one more time. Personal impressive rules that I use. All right, like I said, I'm only trading 1 to 2 contracts per day. We're only trading 1 to 2 contracts per day with a 1 to 2% risk, with 1 to 3 trades per day. All right, you're going to want to start off small, just one contract. This helps you manage risk effectively. You want to risk only 1 to 2% of your account, which keeps you safely in the game even if things don't go as planned. We keep talking about discipline in trading volumes. Limit yourself to a maximum of 1 to 3 trades per day. This prevents you from over trading and making impulsive decisions. Your timing in trading is going to be crucial. Like I said, I often trade in high volume sessions, which is pre-market 8:30 to 9:30 to 11 Eastern Standard Time. Avoid trading during news spikes, which can create unpredictable market conditions, and please steer clear of emotional entries and random scalps. Sometimes they can pay off, sometimes they do not. So, by adhering to your own very structured, impressive rules, you'll build a foundation for disciplined trading. This approach is all about making informed decisions rather than impulsive reactions. Okay, so if you've made it to this point in our webinar, then I assume that you are still highly considering trading futures, that you are highly considering your psychology when it comes to trading as well. All right, because this part, like we keep saying, is going to be the real name of the game, is really about what it is and exposing the game. So, futures trading can seriously amplify your emotions. Whatever you're already feeling, it can amplify it times 10. It can be very easy to fall into common traps like revenge trading, where you will try to recover your losses hastily, or you'll try to move your stop loss to avoid taking a hit. Increasing your trade size after a loss is another pitfall, as is trading out of just sheer boredom. You don't got nothing to do, let's trade. Or trading from bed, right? The key takeaway here, though, is to be calm. The calmest trader have the greatest wins, all right? They're not the loudest. They're quiet. Remember, maintaining discipline and emotional control is what sets successful traders apart. It's not about making the most noise or the quickest trades. It's about strategy. All right, so we're very strategic, we're mysterious, coy, and winning the psychological game in the process. I mean, they tell you winners move in silence, so move in silence, all right? So, frequently asked questions as we wrap this up. Because we got some attention. All right, well, let's dive into some frequently asked questions that often come up in trading. Is it gambling? Well, unlike gambling, trading often it uses risk management. Okay, it uses risk management and strategy and pattern recognition. It's about having an edge and not just leaving everything to chance and wit and luck. Next, how much do I need to start? So typically you want to start with a very small account, or a very small margin is required. You'll want to start with at least $500 to $1,000 in order to maintain your risk effectively. Can I lose more than my account? With proper stop loss strategies and risk management, the answer is no. However, without discipline, there is a very high possibility. Why not just trade stocks? So as we talk more about our investments, like I said, we're doing all of them, all right? Futures trading is just going to be another additive to our investments. So futures uses or offers us leverage, which allows us greater liquidity, which is going to, and they don't have a pattern day trading restrictions, okay, which is going to allow us a lot more advantages for us as traders. There's a lot less restrictions. Now, lastly, which one is better for you, MES or MEQ? This is honestly subjective. It's personal. One is a little bit more volatile than the other. So, if you prefer a more smoother trading experience, then I'd go with MES, the S&P. And if you're looking for a lot more volatility, quicker movements, then I'd go with MNQ, the NASDAQ. All right, so remember, the key for you to be successful in trading is not just having the knowledge, but also maintaining the very disciplined and poised approach. So your next steps here. All right, your next step, if you want, I have a free futures quick start download. All right, we're also going to have a webinar where you can trade while you train for your prop firm exam. Okay, we also have a trading psychology course that is going to be available. All right, because like we said, trading psychology is the most crucial step in our journey, your mindset. All right, y'all. I just want to leave this mantra with you. I hope that this webinar found you, well, if you are trying to live a more softer, independent, financially free life, understand that a soft life does not mean soft discipline. The most powerful trader in the room is the calmest one. Thank you for watching. I hope to see you on my trading journey. This is Impressive Investments, where futures are traded in the present moment. I will catch y'all in the next one. Peace.